Welcome to Talk Tickers, where we break down those earning calls so you don't have to.
Yep, getting straight to the core info.
Today, we're diving into Brookfield Corporation's first quarter 2025 call. And spoiler alert, it looks like a pretty strong start to their year.
Absolutely, a strong start indeed. Their distributable earnings before realizations, that's a key metric for them, jumped 30% compared to last year.
30%, wow.
Yeah, hit $1.3 billion, which is 82 cents per share for the quarter.
Okay.
And if you look back over the last 12 months, that number's $5.2 billion or a 3.26 cents per share. So consistent performance there.
And that strength wasn't just isolated, right? It was across the board.
Pretty much. Asset management, their operating businesses, and importantly, their Wealth Solutions group all performed well. Wealth Solutions actually hit that target 15% return on equity they've been talking about.
Got it. Okay, so that's the headline. Let's take a bit deeper. Their CEO, Bruce Blatt, gave the business update. He mentioned kind of a mixed economic picture.
Right. He said the year started with some positive economic momentum, but then, well, trade policy concerns created some volatility in the capital markets. But, and this is key for Brookfield, he argued their businesses are generally quite insulated from that kind of broader turbulence.
How so? What's the shield there?
Well, it's really the nature of what they own and operate. Think essential services, things people need regardless. Plus, they're mainly focused on domestic operations within the, 30 countries they're in?
Okay.
And a lot of their revenue streams are contracted or regulated. That means they can often pass through increased costs, which provides a buffer against inflation or supply chain issues affecting margins.
Right, so less exposure to those global trade winds, maybe.
Exactly. And despite that market choppiness Blatt mentioned, he really emphasized these sort of mega trends that are actually working for them.
Like de-globalization.
De-globalization, yeah. And digitalization, decarbonization, these big shifts are apparently driving a lot of investment opportunities their way.
Makes sense. And they're putting money to work.
Big time. $20 billion committed to new acquisitions just in Q1. They feel they're getting good value despite, or maybe because of, the volatility.
Okay, so deglobalization means more local infrastructure needed. Reshoring.
That's a big part of it, yeah. Reshoring supply chains creates demand for new facilities, logistics, energy infrastructure, and then the digitalization piece, AI breakthroughs, the massive growth in data centers.
That needs power. Lots of it.
Exactly. And who's a huge player in renewable energy? Brookfield. So it creates this natural demand for their capital and their operational know-how.
And they certainly have the capital. What was the number?
A record $165 billion ready to deploy.
Wow. Okay. And existing assets, how are they doing? Real estate, for instance.
Seems quite healthy, especially for high-quality assets. They're seeing a strong demand meeting, well, somewhat muted new supply.
This means
Stronger rental growth, higher occupancy. He specifically called out New York City office leasing being the highest it's been since 2019.
That is interesting, given all the talk about office space.
It really highlights that flight to quality. You know, location and building quality still matter. Blatt also kind of zoomed out, talking long-term.
Right, the compounding message.
Yeah, reminding folks that shareholders who stuck with them for 30 years saw an 18% annualized return. It's about staying invested, he argued.
And that long-term view ties into how they manage capital, that centralized approach.
Precisely. He stressed how making reinvestment decisions centrally is key to scaling the business and navigating economic cycles, allows them to be opportunistic.
Like buying back their own shares.
Exactly. They snapped up $850 million worth this year because they saw the price dip, felt it was undervalued. It's part of that disciplined, adaptive approach they keep talking about.
Okay, disciplined approach. Let's pivot to the hard numbers with Nick Goodman, the president. We got the DE before realizations. What about including realizations?
Right. So realizations are basically the profits they make from selling assets. When you add those in, the distributable earnings, or DE, jump to $1.5 billion for the quarter.
98 cents per share.
Yep. And over the last 12 months, that total DE number is $6.6 billion, or 4.17 cents per share. Gives you a fuller picture of earnings, including those gains from selling stuff. Net income was also $1.5 billion for the quarter.
Got it. And the engine room, asset management, distributions and fundraising looks strong.
Very strong. They sent out $684 million in distributions from asset management in the quarter, and fundraising momentum is, well, massive.
How massive?
$25 billion in inflows just in Q1. Over $140 billion in the last year.
That's huge.
It really is. And a big chunk of that was closing their latest real estate flagship fund. They brought in about $6 billion more, taking total commitments to $16 billion.
Largest ever for them in that space.
Largest ever for their opportunistic real estate strategy, yeah. And all this new capital feeds directly into their earnings.
Pre-fees.
Exactly. Fee-bearing capital grew 20% year over year, hit $549 billion. And that drove fee-related earnings up 26% to a record $698 million in the quarter. It's a virtuous cycle.
More capital, more fees. Makes sense. Now, Wealth Solutions, we mentioned they hit their ROE target. What else is happening there?
Well, they generated $430 million in distributable operating earnings for the quarter. But the growth story is maybe even more impressive. They originated $4 billion with a B in retail and institutional annuities in just 3 months.
Wow.
And their statutory capital base is now over $16 billion, supporting that 15% plus ROE. They're pulling in nearly $2 billion a month in retail capital now across their platforms.
$2 billion a month. Where's that coming from?
A mix, but over $650 million of that monthly figure is from private wealth channels. It shows they're really tapping into different investor pools effectively.
Okay, that's a serious growth engine. What about the more traditional operating businesses?
Still chugging along nicely, $426 million in DE for the quarter. We touched on real estate already, high occupancy at 95% in the core portfolio, decent same-store NOI growth around 3%.
And leasing activity was strong too, you mentioned.
Yeah, about 9 million square feet signed across office and retail globally. And importantly, especially in those premium office buildings, the new rents are significantly higher than the ones rolling off.
Good sign for future income.
Definitely shows pricing power in the right spots. They also made a strategic shift in their North American residential business.
What was that?
Moving to more of a capital light model. They sold 5 big master plan communities for about $640 million, freeing up that capital.
Okay. Now, you mentioned realizations earlier. They also talked about carried interest, right? $189 million realized. Can you just quickly explain carry?
Sure. Carried interest, or carry, is basically the performance fee. It's the share of profits the manager, Brookfield, in this case, gets when an investment does really well, usually above a certain hurdle rate.
So it's like a bonus for good performance.
Essentially, yes. And the fact that their unrealized carry grew to $11.6 billion is significant.
Why is that?
Because it reflects value that's been created in their funds but hasn't been cashed out yet through asset sales. It suggests there's a lot more profit potential still sitting in those investments ready to be realized in the coming years. They actually expect a substantial step up in realized carry soon.
Okay, so future earnings potential baked in there. And they were selling assets too.
Oh yeah, very active. Closed about $22 billion in asset sales in Q1. And crucially, they said these were at or above the values they were carrying them at on their books.
Good validation of their valuations. Any examples?
Some hospitality assets in Florida, a stake in a global logistics company. They also mentioned the sale of the NGPL gas pipeline is moving ahead, expecting good proceeds, like an 18% IRR, 3x multiple on that one.
Solid returns.
Yeah.
And they're putting that cash back to work.
Yep. About $3 billion reinvested back into the business. Some went to pay down debt in real estate. Some funded commitments to their own private funds. And a chunk went to fuel that growth in Wealth Solutions.
Plus returning capital to shareholders.
Absolutely. Over $700 million returned via dividends and those share buybacks in the quarter alone.
And they feel comfortable doing all this because the balance sheet is strong.
Very much so. They emphasize being conservatively capitalized, but still having that record $165 billion of deployable capital. They also managed to do over $30 billion in financing, including issuing a 30-year bond at what they called their tightest spread ever. Shows market confidence.
Okay, and the dividend?
Declared 9 cents per share for the quarter, payable end of June.
All right, let's zoom in a bit more on Wealth Solutions. Sachin Shah, the CEO of that division, gave an update. What were his key points?
Well, he started by highlighting the sheer scale they've achieved relatively quickly. Over $140 billion in assets now, $1.7 billion in annualized earnings, and that's $16 billion plus in statutory capital.
Impressive growth.
And he really stressed the synergy, how Wealth Solutions benefits from and contributes to the wider Brookfield ecosystem. Access to fund products, credit expertise, real asset knowledge.
Like using their real estate teams to help the annuity side.
Exactly, leveraging internal expertise. He also made a point about their capital structure being permanent.
Meaning?
Meaning it's not client money or typical private equity funding in their insurance businesses that might want an exit. It allows them to make very long-term decisions, focus on matching simple, predictable liabilities with assets, and just compound capital steadily.
Makes sense. And they're still expanding, specifically in the U.S. annuity market.
Yeah, big push there. They're broadening the product range and really targeting new distribution channels, especially the large banks.
Why banks?
Because banks represent something like 60% of U.S. retail annuity sales, but Brookfield only got about 30% of their sales through banks last year. So huge untapped potential. They expect to be on several big bank platforms in the next year and a half.
That could really move the needle. What about internationally?
They're just starting, but making moves. Got that pension risk transfer, or PRT, license in the UK.
That seemed like a big deal. First one since 2007.
Yeah, it's significant. The UK pension market is the largest globally. Tons of defined benefit plans looking to offload risk. They see maybe $500 billion in deals there over the next decade. And right now, not many players can handle it.
Interesting. And the U.S. PRT market.
Also growing. They started with smaller deals, now moving up market.
Yeah.
That's maybe another $350–500 billion opportunity over the decade. So PRT is a big focus alongside retail annuities.
So adding it all up, how much business do they expect to write this year?
They're targeting $25 billion in combined retail and institutional annuities for the calendar year 2025. They noted Q1 is usually slower, so expect a ramp up.
And they feel confident they can invest all that premium effectively.
That's where the Brookfield ecosystem comes in again. They leverage the whole platform to find attractive, risk-adjusted returns. Plus, they're sitting on over $15 billion in cash and $40 billion in liquidity, ready for opportunities.
Okay, so the message from Wealth Solutions is on track, executing the plan, focused on that 15% plus ROE.
Pretty much sums it up. They seem very confident in the trajectory.
Okay, stepping back then. If you had to boil down the key takeaways from this whole call for listeners.
I'd say, 1, strong underlying earnings growth driven by both fees and operating businesses. 2, massive fundraising success, which fuels future fee growth. 3, Wealth Solutions is becoming a really significant high-return contributor. 4, they're actively monetizing assets at good values and redeploying that capital effectively, including back to shareholders. And 5, they feel well-positioned to benefit from those big macro trends, de-globalization, digitalization, decarbonization, with a ton of capital ready to go.
Resilience and strategic positioning seem to be the themes.
Yeah, navigating the volatility while playing the long game.
All right, let's shift gears to our This Is Not Financial Advice segment. Always fun. Got an outrageous but plausible trade idea based on this call.
Okay, here's one building on that UK pension risk transfer angle we just discussed. Brookfield is clearly making a big push there. It's a huge market, and they just got that rare license. Competition seems limited for now. So the trade idea. Consider going long a select basket of publicly traded UK asset managers or investment firms, maybe even some smaller insurance players that are already active or expanding in pensions, annuities, or bulk purchase annuities. Basically betting on the UK PRT ecosystem.
Right, riding the coattails of that market growth, potentially.
Okay.
What's the outrageous part?
The outrageous hedge is to pair that long position with a short position on a broad European financial services index, like the Euro stocks banks or financials.
Okay, why?
The bet is that the specific growth drivers in the UK PRT market, the regulatory environment, the sheer size of the pension scheme's de-risking will allow these UK-focused players to significantly outperform the broader, more diverse European financial sector, which faces different headwinds. You're isolating the UK PRT theme.
So betting on UK pension specialists against the wider Euro finance sector. Interesting.
It banks on Brookfield's entry, raising the profile, maybe sparking M&A, or just re-rating the whole niche, but again, purely hypothetical.
Absolutely. Do your own research, folks. This is just for discussion. So, wrapping up, Brookfield's Q1 paints a picture of a complex machine firing on, well, most cylinders.
Definitely. Strong earnings, huge capital flows, strategic execution, lots happening across asset management, their operating units, and especially that fast-growing Wealth Solutions business.
Plenty for investors to chew on. We definitely encourage you to look deeper into their filings if this is a company on your radar. Think about how these pieces fit together. What really caught your eye from this deep dive? Thanks for tuning in to Talk Tickers.